Dividend ETFs are a great way to invest for dividends, and you get instant diversification. My job is to find the best dividend ETFs in Europe. The ETF we will look at today has a focus on Europe, excluding the UK. Cue the classical music and let's dive in. Welcome back everyone, I'm the Swedish dividend investor. So today we will revisit Vanguard FTSE Developed Europe ex-UK UCITS ETF. Ticker VERX. I made a video in July where we went through their holdings, dividend history, etc. A difference now is that we have the full year 2025 dividend, so we can update our valuation, since we don't want to overpay for an investment. We will also see how their holdings have changed and also the performance. As always, this is not financial advice. I'm just sharing my own investing journey, my experiences and my analysis. Read the full disclaimer in the description. Alright, heading over to justetf.com, we can read the following. VERX seeks to track the FTSE Developed Europe ex-UK index. The index tracks large and mid-cap stocks from developed countries in Europe excluding the UK. We can see their fund size is 3.18 billion euros and a very low 0.10% total expense ratio. The fund is domiciled in Ireland, so usually that means less taxes for you. The fund has 431 holdings, so it's pretty diversified. And their top 10 is the following: ASML, Roche, Novartis, Nestlé, Siemens, SAP, Banco Santander, Novo Nordisk, Allianz and Louis Vuitton. Last time we looked, we saw Schneider Electric but not Banco Santander, and the order of the top 10 is a bit shuffled, where SAP used to be their biggest holding but has now been overtaken by ASML. Country allocation. If you want to read the full numbers, just pause the video. Switzerland, Germany, France, Netherlands, Spain, Sweden, Italy, Denmark, Finland, Belgium, Norway and other. Last time around, Germany and France was in the top, and Switzerland at third largest country allocation. So, a bit different here as well. Sector allocation. Financials, industrials, healthcare, technology, consumer discretionary, consumer staples, utilities, basic materials, telecommunication, energy, real estate and other. So tech has been reduced from the top 3 and healthcare has taken its place. Last time we didn't look at the performance, but we will compare it to S&P 500, VDIV, FEUI and SPYW. In my opinion, last year's best value. We will do a revisit on those as well during the year. So the first time frame is around where I first made the video on VERX. We got SPYW at the bottom, 6.06%, followed by VERX at 10.68%, FEUI at 11.96%, S&P 12.04% and VDIV absolutely crushing it with their 24.11%. The year-to-date performance, I will just show it on the screen. 1 year performance. SPYW at 11.22%, VERX at 13.14%, FEUI at 14.54%, S&P at 15.54% and VDIV at 24.55%. For the 5-year performance, we can see SPYW at 51.81%, FEUI at 52.51%, VERX at 58.6%, S&P 88.28% and VDIV in the lead with their 130.35%. Let's check their dividend and dividend history. Before moving on, if you like my work, don't forget to like, comment and subscribe. It helps a lot. Thanks. So in my original video, we didn't have the full year dividend, but the first 6 months were higher than 2024's first 6 months. And since we didn't have the full year dividend, I did the valuation on the 2024 dividend. I'm getting ahead of myself here. Switching tabs to the current information. We can see they managed to raise their dividend with 7.69% since 2024, from 1.1385 euros to 1.2261 euros, making the current yield 2.66%. Now, that's way too low for me, but as we can see, the dividend growth is pretty decent. We got a 3-year compound annual growth rate of 7.23%, 5-year at 14.52%, and a 10-year of 5.65%. Probably dragged down with the 35% haircut they got in 2020. We will base the valuation on these growth rates. Time for the valuation. Last time we got 33.34 euros, and with a 5% margin of safety, we got a price of 31.67 euros. Why do we do valuations? Because we don't want to overpay for an investment. The calculation is based on what I believe the dividend growth would be, and a discount rate for our required return and a terminal multiple. We use 3 scenarios: normal, best, and worse. And finally, we do a mixed valuation, where we use a probability factor for each case to get a fair price between them. I am using a 10% discount rate or required return for all cases. The calculation goes 10 years in the future. For the normal case, I've gone with a 5.6% growth. That's the 10-year CAGR. Terminal multiple of 33. That equates to a yield of 3.03%. And that is what we believe investors would want 10 years in the future. We get a present value of 35.34 euros. Ouch. Compare that to the price today of 46.04. For the best case, I've gone with a growth of 8%, and that might be too much, and a terminal multiple of 37, so a yield of 2.7%. We get a present value of 46.06 euros. So, for an annual 10% return, based on the current price, we would need an 8% growth. Yikes. For the worst case, I've gone with a 3.5% growth. Remember, this could be with a cut included and then some higher growth, just a long-term growth of 3.5% over 10 years. Terminal multiple of 30, so a yield of 3.33%. Is this really the worst case? Who knows? I would say if the shit hits the fan, it would probably be worse. We get a present value of 28.23 euros. Let's do the mixed valuation. I've gone with 60% probability for normal case and 20% each for best and worst case. We land at a fair price of 36.06 euros or 34.26 euros with a 5% margin of safety. Now, compare that to 46.04 euros per share. We would need to go down pretty hard to reach the fair price. If we change our required return to 7%, we can see we get somewhat in line with today's price. So, what conclusions can we draw from this? If you're happy with a 2.66% yield and maybe around a 7% annual return and believe the dividend growth will be over 8% per year, then this could be a buy. From my perspective, the yield is way too low, and the stars really need to align for this to play out well. And I rather invest in something more fairly valued based on really conservative numbers. Kind of like my valuation of FEUI and VDIV last year. It's surely a great ETF with low fees and pretty good growth. But I'm going to say pass on this one. I want to know what you guys think of this. Do you hold it? Do you have it on your watch list? Let me know what you think in the comments. That's it for today. I will see you guys in the next one. Until then, stay smart, stay patient and keep stacking those dividends. Ha det gött!